Welcome. Today we're diving into the world of economics to explore the difference between real GDP and nominal GDP. GDP, or gross domestic product, is one of the most important indicators used to gauge the health of a country's economy. But did you know there are actually two main ways to measure it? Understanding the distinction between real and nominal GDP is crucial for interpreting economic data accurately. In this video, we'll break down what each term means, why the difference matters, and how these concepts impact our understanding of economic growth. Let's get started by first understanding what GDP itself represents. GDP stands for gross domestic product. It's the total value of all goods and services produced within a country's borders over a specific period, usually a year. Economists use GDP to measure the size and performance of an economy. When GDP grows, it generally means the economy is expanding, and when it shrinks, the economy is contracting. However, the way we calculate GDP can vary, which brings us to the concepts of nominal and real GDP. Before we get into those, let's quickly look at why GDP is such a widely used metric. GDP is more than just a number. It helps governments, businesses, and individuals make informed decisions. For example, policymakers use GDP data to shape economic policy, while investors look at GDP trends to decide where to put their money. It's also used to compare the economic performance of different countries. But to make these comparisons meaningful, we need to understand the difference between nominal and real GDP. Let's start by defining nominal GDP. Nominal GDP is the total value of all goods and services produced in a country, measured using current market prices during the year they are produced. This means nominal GDP does not account for changes in the price level or inflation. If prices rise from one year to the next, nominal GDP will increase even if the actual quantity of goods and services produced stays the same. So nominal GDP can sometimes give a misleading picture of economic growth if inflation is high. Imagine a country produces only two products, apples and cars. In 2020, apples cost $1 each and cars cost $20,000 each. If the country produces 1,000 apples and 10 cars, the nominal GDP is calculated by multiplying the quantity by the current prices and adding them together. If in 2021, prices rise to $1.10 for apples and $21,000 for cars, but production stays the same, the nominal GDP will still increase, even though the actual output hasn't changed. This is because nominal GDP reflects both price and quantity changes. While nominal GDP is useful for measuring the value of production at current prices, it has its limitations. The main issue is that it doesn't separate changes in output from changes in prices. This means that if inflation is high, nominal GDP might suggest the economy is growing faster than it actually is. To get a clearer picture of real economic growth, economists use real GDP, which adjusts for inflation. Real GDP measures the value of all goods and services produced in a country, but it adjusts for changes in the price level or inflation. By using constant prices from a base year, real GDP allows us to see whether the economy is actually producing more goods and services, rather than just charging higher prices. This makes real GDP a better measure for comparing economic growth over time. Calculate real GDP, economists use the prices from a selected base year. This means that even if prices change in the current year, real GDP will only reflect changes in the quantity of goods and services produced. For example, if the base year is 2020 and you're calculating real GDP for 2021, you'll use 2020 prices for both years. This way, any increase in GDP truly represents an increase in production, not just higher prices. Let's revisit our apples and cars example. Suppose the base year is 2020. In both 2020 and 2021, you use the 2020 prices to calculate GDP, regardless of any price changes in 2021. If the number of apples and cars produced increases in 2021, real GDP will rise. But if only prices increase and production stays the same, real GDP remains unchanged. This helps us see the true growth in economic output. Real GDP is especially useful for tracking economic growth over time. By removing the effects of inflation, it allows economists and policymakers to see whether the economy is actually expanding in terms of production. This makes it easier to compare economic performance across different years and even between countries, as it provides a more accurate picture of real growth. Now that we've defined both real and nominal GDP, let's compare them directly. Nominal GDP measures the value of output using current prices, while real GDP uses constant prices from a base year. This means nominal GDP can be influenced by inflation, but real GDP is not. By comparing the two, we can get a sense of how much of GDP growth is due to higher prices versus increased production. Measure the impact of inflation. Economists use a tool called the GDP deflator. The GDP deflator is a ratio of nominal GDP to real GDP multiplied by 100. It shows how much prices have changed since the base year. If the GDP deflator rises, it means prices are increasing. This helps us separate real economic growth from inflation. See how the GDP deflator works in practice. Suppose nominal GDP is $110 billion and real GDP is $100 billion. The GDP deflator would be 110 100 100 equals 110. This means that prices have increased by 10% since the base year. The GDP deflator is a useful way to track overall price changes in the economy. Understanding the difference between real and nominal GDP is important for making accurate economic comparisons. If we only look at nominal GDP, we might think the economy is growing rapidly, when in reality most of the growth could be due to rising prices. Real GDP helps us see the true increase in production, making it a more reliable measure for economic analysis. GDP is often used as a proxy for living standards, but it's important to use real GDP for this purpose. Real GDP per capita, which divides real GDP by the population, gives a better sense of the average standard of living in a country. This helps policymakers and researchers understand how economic growth is affecting people's lives over time. While GDP is a valuable tool, it doesn't capture everything about an economy's health. For example, it doesn't account for income inequality, environmental impacts, or unpaid work like volunteering. Both real and nominal GDP have these limitations, so it's important to use them alongside other indicators for a complete picture of economic well-being. Inflation can have a big impact on GDP figures. When prices rise, nominal GDP increases even if the actual quantity of goods and services produced doesn't change. That's why economists prefer to use real GDP when analyzing economic growth, as it removes the effects of inflation and gives a clearer picture of true output changes. In comparing economies across countries, using real GDP is essential. Different countries experience different rates of inflation, so comparing nominal GDP can be misleading. Real GDP, especially when adjusted for purchasing power, allows for more accurate comparisons of economic output and living standards between nations. Purchasing power parity, or PPP, is another adjustment economists use to compare real GDP between countries. PPP takes into account the cost of living and price levels in different countries, making it easier to compare what people can actually buy with their income. This is especially useful for understanding differences in living standards worldwide. Economists often look at GDP growth rates to assess how quickly an economy is expanding. It's important to use real GDP growth rates as they show the true increase in production, not just higher prices. Tracking real GDP growth helps governments and businesses plan for the future and respond to economic challenges. Governments use GDP data to guide economic policy decisions. For example, if real GDP is falling, policymakers might introduce stimulus measures to boost growth. If nominal GDP is rising but real GDP is flat, it could signal inflation is a problem. Understanding the difference helps policymakers respond appropriately to economic conditions. Businesses also rely on GDP data to make strategic decisions. Real GDP growth can signal rising demand for products and services, encouraging companies to invest and expand. On the other hand, if nominal GDP is rising mainly due to inflation, businesses may be more cautious. Accurate GDP data helps businesses plan for the future. Even individuals can benefit from understanding GDP. Real GDP growth often leads to more job opportunities and higher wages, while high inflation can erode purchasing power. By keeping an eye on real GDP trends, people can make better decisions about spending, saving, and investing. GDP figures are also used to track economic cycles such as recessions and expansions. Real GDP helps identify when an economy is truly shrinking or growing, as it removes the effects of inflation. This information is vital for governments, businesses, and individuals to prepare for changes in the economic environment. Central banks use GDP data, especially real GDP, to set monetary policy and target inflation. If real GDP is growing too quickly, it can lead to inflation, prompting central banks to raise interest rates. Conversely, slow real GDP growth may lead to lower rates to stimulate the economy. Accurate GDP measurement is essential for effective policy. Wage growth is often linked to real GDP growth. When the economy is expanding in real terms, businesses tend to hire more workers and pay higher wages. However, if nominal GDP is rising only because of inflation, wage increases may not keep up with the cost of living. Real GDP provides a clearer picture of wage trends. Investors look at real GDP growth to assess the health of an economy. Strong real GDP growth can attract investment, while weak or negative growth may deter it. Nominal GDP growth, if driven by inflation, is less attractive to investors. That's why real GDP is a key indicator for financial markets. Government tax revenues often rise with nominal GDP, as higher prices lead to higher tax collections. However, if real GDP isn't growing, this extra revenue may not reflect real economic improvement. Policymakers need to distinguish between nominal and real GDP to make sound fiscal decisions. When assessing a country's debt, economists often compare it to GDP. Using real GDP gives a more accurate picture of a country's ability to repay its debts, as it reflects the true size of the economy. Nominal GDP can be distorted by inflation, making debt levels look more manageable than they really are. Economists use real GDP to make forecasts about future economic growth. Accurate forecasts help governments and businesses plan for upcoming opportunities and challenges. Nominal GDP forecasts are less useful, as they can be skewed by unpredictable changes in inflation. While GDP is a useful measure, it's not a perfect indicator of well-being. Real GDP gives a better sense of economic progress, but it still doesn't capture factors like health, education, or happiness. Economists often use additional measures such as the Human Development Index alongside GDP for a fuller picture. GDP growth can sometimes come at the expense of the environment. Neither real nor nominal GDP accounts for environmental degradation or resource depletion. That's why some economists advocate for measures like green GDP, which adjusts for environmental costs. Still, real GDP remains the standard for measuring economic output. There's a close relationship between real GDP and employment. When real GDP grows, businesses often hire more workers, reducing unemployment. However, if nominal GDP rises only due to inflation, job growth may not follow. That's why real GDP is a better indicator for labor market trends. Productivity growth is a key driver of real GDP growth. When workers produce more goods and services per hour, real GDP rises, leading to higher living standards. Nominal GDP growth, if driven by inflation, doesn't necessarily reflect productivity improvements. That's why economists focus on real GDP for productivity analysis. Economic shocks like recessions or booms are reflected in real GDP figures. A sudden drop in real GDP signals a recession, while a sharp rise indicates a boom. Nominal GDP might not show these changes clearly if inflation is also changing rapidly. Real GDP provides a clearer signal of economic shocks. Economists often break down GDP by sector, such as agriculture, manufacturing, and services. Real GDP by sector helps identify which parts of the economy are growing or shrinking, independent of price changes. This information is valuable for targeted policy and investment decisions. Just as GDP can be measured for a whole country, it can also be calculated for regions or cities. Real GDP at the regional level helps identify local economic strengths and weaknesses, guiding regional development strategies. Nominal GDP is less useful for this purpose due to varying inflation rates. When studying economic history, real GDP is essential. It allows us to compare economic output across decades or even centuries, adjusting for inflation. This helps historians and economists understand long-term trends in economic growth and living standards. Forecasting real GDP can be challenging due to unpredictable factors like technological change, policy shifts, or global events. Still, real GDP remains the best tool for projecting future economic performance, as it focuses on real output rather than price changes. GDP figures are often revised as more data becomes available. Both nominal and real GDP can be updated, but real GDP revisions are especially important for understanding true economic trends. Policymakers and analysts watch these revisions closely to adjust their strategies. After a recession, real GDP is used to track economic recovery. Policymakers look for sustained increases in real GDP as a sign that the economy is bouncing back. Nominal GDP may rise due to inflation, but only real GDP shows true recovery in production and jobs. International organizations often use real GDP to determine aid eligibility and measure progress in developing countries. Real GDP provides a consistent basis for comparing economic performance and targeting assistance where it's needed most. Public understanding of GDP can influence confidence in the economy. When people hear about rising real GDP, they may feel more optimistic about job prospects and income. However, if nominal GDP rises but real GDP does not, the public may not experience real benefits. That's why clear communication about GDP is important. Sum up, nominal GDP measures the value of goods and services at current prices, while real GDP adjusts for inflation using constant prices. Real GDP is a more accurate measure of economic growth, as it reflects changes in actual output rather than just price increases. Understanding the difference is essential for interpreting economic data and making informed decisions. We've covered a lot about real and nominal GDP today. Remember, while both are important, real GDP gives a clearer picture of economic progress by removing the effects of inflation. Whether you're a policymaker, business leader, or just curious about the economy, understanding this distinction will help you interpret economic news and data more accurately. Thanks for watching and keep exploring the world of economics.